Picture this. You bought your dream home in 1995 for $300,000. Fast forward to today, and it's now worth $1.8 million. Sounds like the American dream, right? But what if selling your home during retirement came with a six-figure tax bill? Imagine finally deciding to downsize, perhaps to move closer to the grandkids, or being forced to sell your home to cover medical expenses. Then, surprise, Uncle Sam shows up asking for his cut. Unfortunately, more retirees are finding themselves in this type of nightmare situation. But here's the good news. There are smart strategies to reduce or even avoid the tax hit. My name is JP Geisbauer. I'm a certified public accountant, a certified financial planner professional, and this channel is dedicated to helping Americans retire smarter and live better. I release videos weekly, so if you enjoy this content, please hit like and subscribe, and you'll be notified when the new videos are released. In today's video, we're talking about one of the biggest financial assets retirees own, their home, and more specifically, the tax trap that occurs when you sell it. By the end of this video, you'll know how the current tax rules work, why more retirees are getting hit with the unexpected taxes, and 4 key strategies to keep more of your hard-earned equity. Now, retirement planning can be incredibly complicated. Sometimes seemingly small changes in fact patterns can have dramatic impacts on one's income taxes. So none of this information presented today should be considered specific advice for your situation. This video is for entertainment and educational purposes only. Here's the deal. Under IRS rules, if you sell your primary residence and have lived in it for 2 of the last 5 years, you can generally exclude up to $250,000 in profit if you were single and $500,000 if you were married filing jointly. Sounds generous, right? Well, that $250,000, $500,000 cap was set back in 1997, and it hasn't been adjusted since. To put that in perspective, if it had kept pace with inflation, it would be closer to $500,000 for singles and $1 million for couples today. So what does that mean? Let's say you're married and you bought your home in California in the early 90s for $300,000. Today, it might be worth $1.8 million. On paper, that's a $1.5 million gain. Subtract the $500,000 exclusion, and you've still got a $1 million capital gain subject to capital gains taxes. Yikes! And remember, federal capital gains can be as high as 20%. Plus, you may need to add the 3.8% net investment income tax for higher earners. And given this couple lives in California, the state income tax rate could be around 10%. Suffice it to say, the sale of this home could generate an eye-popping tax bill. You might be thinking, that's only for people that live in really expensive markets, right? Not anymore. According to the National Association of Realtors, nearly 1/3 of US homeowners already have gains that exceed the lower exclusion limit. And by 2030, that's expected to be more than half of all homeowners. About 44% of US homeowners are already age 60 and older. That means retirees are the ones who could likely take this on the chin. This leads to what economists call the lock-in effect. Retirees stay put in homes that, quite frankly, don't fit their lifestyle anymore, just to avoid the tax bill. I recently spoke with a couple in California. Their kids are grown and live on the East Coast. One recently had their first grandchild. They'd love to move closer, but their house has appreciated so much over the past 30 years that selling it now would trigger a tax bill of hundreds of thousands of dollars. So instead of downsizing and enjoying retirement in your family, they're stuck maintaining a big house that, quite frankly, they don't need anymore. So can anything be done to avoid this? Yes, there are a couple of strategies that can be used to soften the blow. Strategy number 1. Document your cost basis. Your cost basis isn't just what you paid for the home when you initially purchased it. It includes major improvements like adding a room, replacing the roof, and updating the kitchen to replace those 1990s oak cabinets with ceramic pulls. These improvements can really add up. So if you spend a couple $100,000 getting your home just the way you like it, your taxable gain could be reduced by this amount. Strategy number 2, time your sale. You can use the exclusion once every 2 years. So if you own multiple homes at different points in your life, carefully spacing sales can shield more gains. Consult with your tax advisor before giving this strategy a throw. Timing also matters in relation to your income. Don't sell in a year when you've got unusually high income. That could push you into a higher tax bracket and even increase your Medicare premiums because of IRMA surcharges. Strategy number 3, Coordinate with retirement planning. For example, if you're retiring and your income will drop significantly in the next couple of years, you might want to wait to sell until then. That way, your overall taxable income is lower and you could save thousands in taxes. Strategy number 4. Integrate estate planning. If you hold onto the property until death, your heirs get a step up in basis. That means the value resets to the fair market value at the time of your passing. So if your $300,000 home is now worth $1.8 million when you pass away, your heirs' basis is $1.8 million, and if they sell shortly after, there's little to no taxable gain. So if you ever see a really rundown house in a super nice neighborhood, I'd be willing to bet that someone somewhere is waiting for Mammy and Pop to kick the bucket so they can get the step up in basis. Let's look at a mini case study. Let's say a retired couple has a $1 million gain on their home. By adding $250,000 in documented improvements to their basis, waiting to sell until their income drops, and avoiding an IRMA year, they might save well over $70,000 in taxes. That's a pretty good return on some pretty easy planning. Now, there are some other more complex strategies, including an installment sale, converting the home into a rental while waiting for the step up in basis, and reverse mortgages. But these can be quite complicated. So make sure you consult with your tax and financial advisor professional before using any of these. I do have some good news. Some of you may have heard about the No Tax on Home Sales Act. It's been introduced in Congress and it would eliminate federal capital gains taxes on primary home sales. Sounds amazing, right? But here's the reality. Proposals like this often take years to become law. So don't wait around for Washington to fix this problem. Plan as if the current rules are here to stay. So if you're getting close to retirement and not sure what to do with your home, don't wait until you have the for sale sign planted in your front yard. Get a plan in place today. Are you dealing with this home sale tax trap? What's your home appreciation story? I read every comment and often turn them into future videos, so feel free to let me know in the comments below. Also, if you'd like to schedule a time to discuss this issue as it relates to your comprehensive retirement plan, click the first link in the description to book a free call with me. And if you're looking for other things to potentially downsize during retirement, check out this video I did here. Thanks for watching, and I'll see you next time.